Today, we're talking about put credit spreads. This is easily my favorite option trading strategy. It's very easy to generate sustainable income and sustaining over time. Let's get through what makes a good put credit spread. How do we enter? How do we manage our risk as we go through this trade? And how do we exit on the backside with a profitable trade? And how do we manage downside risk? Okay, so the bull credit spread has a market bias of between neutral and bullish. So what we're trying to do is identify those stocks that have a bullish trend or a good market sentiment that says, hey, this stock is going to have a good upward trajectory. So we're looking at things like right now with the AI trade. So there's a tendency for chip makers to do very well at this time. And at the same time, we don't want to do so much software type stocks because they have a somewhat neutral bias right now, but are very bearish, I would say. And your edge with a put credit spread is that you're looking for time decay. You want to be positioned just a little bit lower than the market price. And then we can have some time decay, or we can have some volatility crush as well, too. The thing that's very attractive about a put credit spread is it's capital efficient. So with much less with much less capital than you would have with a cash secured put, you can use far less capital than you would have to have for a cash secured put. All right, so this is the profit and loss profile that you would see with a put credit spread. So with this, we're using Google as our example. We're pushing this out to March 20th here. This was taken a couple of nights ago, so the market price here of 303 is a little dated. But we would sell the 300 put, and that's the mark there with the strike. So the 300 put, we would sell that. And then with the income that we generate from selling that 300 put, we're able to buy the 295 put there. We buy the 295 as a long put, and that's going to hedge our downside. And because of that, what we have is a nice green profile here for our upside profit. And then this is our loss or our risk that we have. The attraction of the put credit spread is that we've capped our losses. So with the cash secured put, this would continue to go down, and you would see there's unlimited risk to the downside, so to speak. And so you've capped your downside risk and you've also capped your upside risk. So you have a defined profit and a defined risk trade here. And the maximum credit that you would be getting on this is 172.50 or $172. And your maximum loss that you would have in this scenario is 327. So you have a defined risk and defined profit on this trade. So very attractive. And you're able to stay out of the money, right? So this is for March 20th. At the time, it was at 303. So you're able to stay below the prevailing market price. And on a day like today, when Google has risen up to $315, then on that scenario today, you would have been able to make some good money on this trade here with the upside participation. So let's just take a look here at Google. Yeah, it closed at 314.98. And after hours, they put on a few more pennies there. The mathematical edge that you have with the put credit spread. So the first thing you have is Theta Decay is working for you. And because we're usually going to be able to pick expiries that are 30 and 45 days out, what that means is you're going to have the accelerated time decay that's going to be with you on that. So, hey, Uzi, welcome to the show. Thanks for joining today.
Hey, Stephen. Yeah, thank you for having it.
We just got started, actually. We covered up some of the basics there with the put credit spread, with the defined risk, and also the defined profit. With Theta Decay, that's going to give you, as you know, as options go into the future, they lose prime value. And so an option that you shorted that's 30 or 45 days out, you're going to have an acceleration of time decay and a lot of theta erosion in that option. And you're going to be able to book that as profit for you. Did you want to maybe just get ready to talk about probability if you're staying out of the money with the Delta 20, Delta 25, and I'll talk about margin efficiency while you get your thoughts together on that. This is showing the typical difference between a cash secured put and a credit spread. Dollar for dollar, you need about $10,000 to secure the same amount of income that you can generate from a put credit spread. While you can have $1,000 at capital or at risk, that's going to generate the same, almost equivalent as a cash secured put. Now, in order to get that, you're probably going to have to trade 2 or 3 more contracts, but for the same amount of risk that you're going to be using, you're going to generate a lot more income with the put credit spread. So those are 2 elements of the put credit spread that are very attractive. Hey, we're going to come in at the 30 to 45 days. That's going to be very efficient for us. We can use our margin more effectively and generate a higher return than maybe putting it in play. And Uzi, if you don't mind just stepping us through the probability there.
Yeah, sure. That's where one of the Greeks called delta come into play. And when we use delta for setting up positions, again, we never just use delta as one component, but it's a strong one. And when we do, we can use it in this type of fashion. So if I'm looking to sell a credit spread, let's say, or even a cash secured put, and we've got a net 20 delta that we're selling. So let's just say you sell a put at 30 delta, and then you buy a put at 10 delta. So that's a put credit spread, and that nets a 20 delta. So theoretically, you can use that it has a 20% chance of it being in the money at expiration, or an 80% probability of profit. Now, the numbers are give or take, especially when you do a spread, because there's something called lag on the long side of things. So that kind of skews the actual profitability percentage, but you can use that as a working guide. And that's how I do it. So if I net, let's say, a 20 delta, when all is said and done with putting on a spread, I'm pretty much not as short of it for sure, because there is no guarantee in trading, but you usually use that as an 80% probability of being able to close it for some type of a profit. Not 100% profit, and not a guaranteed 50% profit, but at least some type of a profit prior to expiration.
Delta, it's a pseudo or a placeholder for probability, and it's the probability that the option would end in the money. It's not to say that you have, like, say, for example, if you're doing delta 20, that's 80% probability that you're going to have a full profit. No, it's just saying that you have an 80% chance of having some profit. What that is, we don't know, but we'll find out as we get into the money or not. So it could be $1 or a penny, and that would count as that 80%, so to speak. We got a trade question here from Mr. Engineer. If the trade has a week or so and the price is so far from my target, should I roll or wait until the last day? What are your thoughts on that one, Uzi?
Because when to roll and when to manage is still debated by some of the best traders, including, like, let's just say Tasty Trade. This is some of the smartest traders in the world. Tom Sosnoff and his partners, they've done a lot of back testing, and they've spoken on it. They have said that they believe that the best management is at 21 days. I've found, after some back testing on my own trades throughout the years, that yes, that's good at times, and sometimes that's not good, because there's always a chance, even if it's far in the money and away from your target, price can move quickly against you and for you. So I've come to find it really depends on how much time you do have till expiration, and how has your thesis changed, if at all. If your thesis has changed and you said there's a slim chance that this could come back for me, but most likely not, given the support and resistance, or given whatever the parameters are that you use for your technical analysis, then it makes sense to roll it as soon as you can, as soon as you come to that change in your thesis. The longer you wait, the less you will be able to get, if you're going to get a credit at all for your roll. And a lot of times you can get a credit, or at least a small debit, if you do it proactively sooner rather than wait until the last couple of days or even the last day.
Yeah, on that one too, I always enter into a trade and I put an 80% profit. So because with a put credit spread, we have a defined profit on that. So we know going into the trade what our maximum profit's going to be. I put my limit order in to close that out at 80%. Once you get 80% of your profit, I think you should close the position, book the profit, and move on. Keep your bank account kind of rolling and working for you. Just have some efficiency there with the capital. If it gets far into the money and it's working against you, once it's kind of made that move, I think personally I would stay with it, and I would wait to roll until the very last moment to do it. That's kind of my tendency on that. Give it as much chance and probability as possible to kind of see it play out, see if it could happen. But you got a good point there. If your thesis hasn't changed, why would you roll? If your thesis is improving, or there's still a chance for it to come out, I would let it go. Like, we've seen that for the trades that we've done too, and sometimes in the very last day it'll move very favorable for you. Let's move on to the next topic here with the put credit spread strike selection. So Uzi, I'll give you my favorite way to select these strikes, then you tell me yours at the very end, okay?
Sure.
So I like to do delta 25 to 35. There's a lot of people that say you should do delta 10, delta 15. I hear ya. Yeah, you have a very high probability of profit on that, but I don't think you're the risk for the reward. You're not getting enough premium. You're not getting enough capture on that. And then you're taking on the downside risk, or that you're going to have to go really wide in order to get a meaningful profit or a meaningful dollar amount out of that. So I kind of say delta 25 to 35 is kind of that sweet spot. expiration date, you should try and get that 30 to 45 days to expiry. That's the steepest curve that you're going to have on the theta curve. So if you go back to this here, I guess this kind of has the theta curve here with the value and the time. If you were going to draw that kind of that diagonal 45-degree line that just hits the apex of that curve, it's going to be around here, right? And that's going to be, if you put it onto a scale, likely around the 30 to 45 days there. And then your risk to reward. So I feel very comfortable if I'm doing a 5-point spread, they're getting something like 125 to 135. If I can get 150, that's fantastic. And that's giving me about that 50% or that 1-to-2 ratio. As I get closer down to that 125, 115, 110 on a 5-point spread, that's where I'm starting to get towards that 1-to-3 risk to ratio. But anything lower than that, I don't want to take it. And then anything above that, where it's like 1-to-1 risk, I'm usually putting in too much delta to get that. So I kind of tend to say around that 125 for a 5-point spread risk return for the risk that I'm taking on. Hopefully that made sense, where I just kind of think of a 5-point spread. I want 125 or better. I don't want to take on more than 150 of reward for that risk that I'm taking on, because I'm probably doing too much delta or something's weird or different with the trade. What do you think, Uzi? What do you like to do on this point?
Great point, Stephen. I agree with all your components there and how you looked at each and every one of them. And that's key, guys. You really do want to take into consideration all these things when you're trying to put together a trade. I know some guys that have been trading a while, they just go by delta, whether it's a cash or put or even like a spread. And you can't, I believe you really do need more than just going by delta. A lot does have to do with your expiration, and a lot does have to do with how much are you getting for that risk, like Steve has said. What I do, every trade for me is different. I like to look at delta. It's one of the first things I do look at. But what I do like to also look at is the IV rank, because stocks have different ranks. So that means how elevated is its implied volatility in relation to its normal history of trading. So if something has an elevated implied volatility, you're actually getting a richer premium compared to when it's trading at a lower implied volatility, because you get paid for the implied volatility, the potential that stocks can move. That's how we get paid on the premium. So the first thing I'll look at is IV rank, and then I'll look at, let's say, the delta. But like, for example, if I'm going to be selling, let's say, a put credit spread or cash or put pivot points on the chart, if I also have moving average support, I will amp up that delta based on the technical analysis. So whereas I may have looked to go with a 20 delta or 22, 25 delta, if I've got enough levels of support, like layers of moving averages, and also supply and resistance and pivots, I'll go up higher in delta. But if there's not much there, I'll go further delta. I'll go to maybe 15 or even 12 or 13, depends, and then just up my contracts so I can increase the credit that way, the premium. So I don't have any one set of rules. I usually look at each and every trade as a unique, one-off, and then manage it according to how it was structured in the beginning of the setup. Like Steven said, I would love to get, 1-to-2 or 1.3 as far as like a credit. So on a 5 wide, I usually try to get nothing less than 80 or 90. And I will take an 80 or 90 and I'll maybe do 2 contracts or something, because I can't get, let's say, the full 100 or 125, 150 like Steven likes to get, but I'll make up for it maybe on the contracts, knowing though I have layers of somewhat support built in. But again, we all know that support can get challenged and even breached. So, you never want to oversize. That's another key, is never want to oversize here.
I don't oversize. So I think to your point there, what we're seeing here, opened up a PC on HIMSS this week. So that's what I was seeing here, is that it was perpetual downtrend for quite a while here for HIMSS. And then as it got down into this week low here, so it started to find some support. So I was reading that as a kid, it's probably going to have a pivot here. Yeah, it's a bit high risk because we have earnings. Earnings can put it to the downside, but earnings can also put it to the upside. Yeah, they report here. So I'm kind of betting on, okay, you're finding support through here. You got a fair value gap right here. So you probably have some gaps to fill here eventually. And so I was able to put in the 13 over 11, put credit spread on that. And I think I got about 50 cents on that 2-point spread. So really tight spread. And I was able to get 50 cents on that. So I'm risking $150 to make $50. I'm 13 on the short strike. So I'm out of the money by $2 and above. And even if I get assigned $13, I have the 11 put to help me on the downside. But with it being a $15 stock, even if we get full on assignment with this, that's okay. We can easily sell calls and get out of that position eventually by using the wheel strategy. So that was one of the trades that we entered into this week here. Very easy. That's a bit risky. It's below the 50 days, below the 200-day, but I just wanted to take that on.
That's a good premium. That's 30% of your risk. We took in a third of what you are risking.
And then we also have the $25 long leaps option on this one here too. So we got some good upside participation if it does decide to surge. So there we go. Okay, let's move on. Go to the next slide here. I think we got to speed up a little bit, Uzi. I think we've been going for 20 minutes and I got like 8 more slides to get through. So we got to try and hurry up a little bit.
Apologize.
Don't blame.
I definitely want to be part of this meeting. I saw the setup. This is great content. So
let's go because we got to talk about pin risk, etc. Okay, let's go. All right. So this is our CFU Weekly Income System. So if you're new to CFU, we get about, right now we're averaging about 2 to 3, maybe 5 new members every day. So we got a lot of new people that are learning this for the first time. If you love credit spreads as much as I do, this is the weekly income system that you want to get very familiar with. This is one of our top ranked performing systems that we have. We've only lost 1 trade out of 155 that we have closed off. It's phenomenal. We've done very well with this. How do we do that? Well, we do take a little bit longer duration. It does take on average about 60 days. So if you're wanting to get in and out of trades at a very high rate, the weekly income system is not going to be your favorite cup of tea. If you can give me 60 days, our return on risk is 25%, and we average $158 per trade that we enter into. The win rate's nearly perfect. So what does this mean is if you come in, I do recommend you start with 1 contract with us. And then after you get more familiar with, you can multiply that and scale up very easily. So 2, 3, 5, 10 contracts as you get more and more used to the system and how it works. But please start with 1 contract. And we almost always trade credit spreads with the weekly income system. So managing the red trade, let's talk about what do we do when we have a trade that doesn't plan out the way that we want it to. Like Uzi said, not every trade works out perfectly. I'll talk about the roll. I'll start with the roll. Rolling is one of the things that I love to do. I've often shared with other people on the show here is that I'm a rollaholic. I'll roll and roll and roll until I can get the trade to go absolutely perfect and into profit. That's my main goal. I want every trade that we enter into to become profitable. I will roll a trade. So what rolling does is, in a simplistic manner, looking at a put credit spread, is to move the strikes down and then move the strikes forward in time. So we have 2 strikes, right? We got 2 on the put credit spread. We want to roll them down, move them down because the trade went against us, and then we're able to put it out into the future. And that buys us additional time. Often we're able to do that for an additional credit. The market will pay us more to go down and out. The weird thing is you do that 1, maybe 2 more times, and the trade works out in your favor and you get all that credit and you're able to put that in the bank. We do widen the margin a little bit, but we are cognizant that we don't want to roll it or widen it too much. And once we get to a maximum, we have to do more rolls into the future in order to get that. So I just want to dispel any rumors like Captain Condor. We don't do that same trading strategy here at CFU. We will cap the maximum risk that we're able to take on. We'll have to use additional rolls into the future there. So rolling works. It definitely is an effective strategy to make profit.
100%. I like to work and manage the position to profitability if possible. Sometimes it is a fight. I mean, that's the first word that came out of my mouth because it feels like a fight. But it's nice to win that fight. And it just takes sometimes a little bit of time.
Stay patient.
Patience is key. Yeah. So if I have a trade that is being challenged and I've done, let's say, what Stephen has said as far as a portion of the management, let's say I'm in a cash secured put and it's being challenged and it's even breached on my cash secured put. And I'm nearing the point where I have to make a decision on management. So a lot of times, if I have to roll it and I can't get a sizable credit for it, what I'll do is I'll go into my charting and I'll do some technical analysis and see where is support, where is the next support if this is really going to keep falling, and then where is resistance on the upside. So a lot of times I'll convert a cash secured put position into what's called a strangle. So a cash secured put means you just sell one side of the trade, that's the put side. A strangle is selling a put and a call. Now, there is some upside risk. It's unlimited upside risk if you don't have a protective long call, which would make it into a spread. So let's just say I'm doing it in one of the accounts I manage that's a larger account. I'll go ahead and manage it and turn it into a full strangle. So I'm going to be short a put cash you could put or small credit, but then I add, because if it's going down against me, I'm somewhat safe because it's not going up. I'll sell the call side to bring in additional premium to help me exit once we get that turnaround balance and it starts to come back for me, I'll have taken in enough premium that I don't have to wait as long for price to appreciate higher to get out. Now, the flip side to that is that added risk of having a naked call. You have to be prepared to protect that. And you could do that by either buying a protective call if it starts to come up against you, or you could just buy the shares. I do that a lot. So if I'm turning a naked strangle, I have no protection, the price starts to turn around and go higher, and it's about to threaten my naked call. Again, as long as you have the assets in your account, you go ahead and you buy those shares, you convert that now into a covered call position. So now you're covered on that, so you have no upside risk. That will add another benefit to you in profit by hopefully, if let's say you have a naked call at 50, you buy the shares at 49.50, it goes through your 50 short strike call. Now you make an extra $50 on the covered call and get you out of your position. So there's so many different ways to convert.
I don't know what's going on with my cameras. I don't know if can you still hear me?
I see you as frozen, Stephen. I see your mouse moving, but your camera's frozen. That's about it. Everything else is working.
Yeah, dang it.
StreamYard does that to my system too. It takes a lot of bandwidth. I'll keep talking in the meantime. So the wheel, if the stock hasn't fundamentally changed or you have rolled a couple of times already, enter into a covered call. Okay, so actually, I didn't even see number 3 until I just read it. So that's actually what I kind of just touched on in the convert number 2. If nothing's really changed, let's say in your position, and you've rolled a few times, you can enter a covered call. If you buy the shares, you can always sell a call. Okay, selling that call is going to bring in more premium. It's going to actually add the profitability factor to that trade because you're bringing in premium and it's lowering your cost basis on the shares that you had bought. So yeah, with management, there's so many get out of jail. If you played Monopoly, there's so many ways to get out of trouble as long as you have a small size in your position. Okay, because if you have 10 contracts and you only have, let's say, a $30,000 account, and you're going to try to convert that into a covered call scenario, and you don't have enough buying power, you're not going to be able to fully convert it. So you'll be still left with some naked calls, which can definitely hurt your account and blow it up too. So always want to make sure your position sizing is adequate for your size account. Slow and steady wins the race in trading. Trying to make too much too soon is definitely a recipe for disaster. I don't think any of us have never gone a little bit heavier thinking we can make a little bit more on this trade. And then that's the one that actually comes back to haunt you. So you always want to be mindful that this is the trade that could be a problem child, and size accordingly to your account. That'll be, if you learn nothing else from some of these seminars, sizing is really everything. You want to live to trade another day. I'll keep going while Stephen is fixing things behind the scenes.
All right, so the silent killer is pin risk. So you're automatically assigned 100 shares for a contract without any warning. Well, I think we've already kind of handled this, and we shared like what you were saying, Uzi, is just manage the trade. You can flip into a call credit spread, you can flip into a strangle, or you can go into the wheel. Unless you're in some really weird scenario, when I get assigned my shares, I don't want to have them, and I can unwind the assignment fairly quickly. That's another one of the benefits of a put credit spread. Because you have the hedge in place, it's very easy to roll and very flexible. You can drop down many different strikes in order to get back below the market price. And with that, with a cash secured put, it's often very difficult to be that flexible and move that low because you have so much debit to cover off. So assignments are really easy to handle with a put credit spread, much easier than a cash secured put. And I think a lot of questions people say is, should I keep the shares? I don't think you should. Get rid of them. Unless you're using the cash secured put as a wheel strategy and you're trying to lower your cost basis and you're trying to get in on a share on a stock that you really want to own. If we're trading put credit spreads, the idea is to get profit. So as soon as we get assignment, we want to unwind that so we can continue to trade the put credit spread. Now, this is a very unique pin risk that could happen. This does happen once in a while with traders. There is a documented case of this happening to somebody who was trading Tesla. Basically, how it worked is before the close, he had an open put credit spread, and heading into the close, Tesla was trading at about 405, and his put credit spread was 400 over 495 or 395. Sorry. And we just kind of pull up a chart and make it a little easier to follow along with that trading view. So let's just pull up Tesla.
Which stock was that, Stephen?
I'm just looking at Tesla right now.
Yes. Okay, Tesla. Yeah, it's down about $70 or 70 cents.
Yeah, so that's not enough to really, my computer's going all wonky.
See your chart.
Yeah, you can see my chart now, but I should be able to see the aftermarket. And so what happened is, let's just say here, this was the strike that he was short, the 410 or whatnot, and it was trading above here going into the close, and he was feeling really secure that nothing would happen. What happened is after the market had closed on a Friday, Elon Musk put out a tweet or some sort of information, and it dropped Tesla below his strike price. One thing we all need to know is that once it had dropped after hours, options can still be exercised. I think they can be exercised until 5:30 p.m. Eastern time. And he thought the trade was done and he walked away. And then after hours at like 4:45, Tesla had dropped significantly below his short strike. And so he got assigned the shares. When Tesla got assigned to him, he didn't know and he didn't get notified of it at the time. And his long put within the put credit spread hadn't been exercised. And so he went away for the weekend thinking he was all good. But then he woke up on Monday morning and he had been assigned a whole lot of shares of Tesla. He had traded multiple contracts in his put credit spread, actually wiped out his account. And so the lesson on this, and this is with pin risk on it, is just be aware of the risk. And it's likely in your interest as a put credit spread trader to close out the position early so that you're not going to head into the weekend with pin risk sitting on your put credit spread.
Yeah. Yes. Good point, Stephen, too, because people think the market stops trading at 4 on a Friday and they can go about their happy hours and travels and such. But if you have open credit, cash secure puts, or even on the upside, if you have a naked call or a call credit spread and the stock has great news and shoots up on either end of it, you could get nailed, because someone who has a long option can call their broker up to 5:30 p.m. on a Friday and exercise that option. Well, they don't exercise it against you. They just call it to exercise, and it's all a lotto ticket. If you get that exercise in your account, then you're going to wake up, like Steven said, Monday morning, or even find out sooner over the weekend, maybe that you've got a problem, depending on how expensive stock is, how many contracts you have, and how much equity you have in your account. So it's definitely close your positions on a Friday. This way you can rest assured you're not going to be exercised on anything that is even far out of the money.
Yeah, or at least be aware of it. And don't, if you have a lot of contracts and you're doing a high risk trade, you definitely want to close that out and not have that additional tail risk into the weekend there. So close that off. Don't hope for that last dime or that last nickel on the trade. Close it off and walk away and have a good, clear peace of mind. We got the volatility crush play. Now, I think we have a local expert on this. Uzi, can you talk us through the IV crush and the earnings trade? I know you're a good earnings trader. I tend to shy away from them, but I think you actually walk into the earnings risk and the IV crush. Walk us through what IV crush is.
Sure. Yes. I actually love trading earnings. I've heard from some experienced traders, guys that have time under the belt, they think earnings trades are a gamble. To that point, I'll simply show them a chart of, let's say, UNH or CrowdStrike or any one of these other names that had a news event overnight, not even an earnings event, a bad news event. They wake up the next morning and their stocks cut 30%. And they'll say, but earnings are really risky. Well, it's no more risky than any other position that you put on, as long as you go into the trade knowing what your risk really is. Now, the nicest thing about earnings, I'll say this, I believe earnings trades can be some of the least risky trades. And I'll tell you why. Let's say you're chugging along, you're in Tesla, stock's been trending higher, you've got some cash secure puts sold because every time you sell puts, it's working, but all of a sudden they have a news event. Something bad happens. Well, let's just say it's UNH now, because UNH dropped 30% in one day, right? And leading up to that, though, as prices drifting higher, implied volatility is actually getting lower and lower and lower. So you're feeling safer and safer selling cash secure puts. Now, bad news hits, and all of a sudden, implied volatility skyrockets because the market makers don't know what's going to happen. So all they know is they need to juice the premiums so they can be protected. And what that does to your position, if you're short, let's say a cash you could put, and the stock drops 30%, 20%, whatever you want to call it. Now, for you to get out of that position, you're going to be paying elevated prices to get out, and you're going to lose a lot more just because of the implied volatility spike. Now, going into earnings, I place my earnings trades an hour or two before the company reports that day, or if it's going to be in the morning, the same thing. I'll put the trade on 3 o'clock in the afternoon because there's a little bit of time, 3 o'clock to 4 o'clock, that anything bad can happen. Yes, something can happen, but pretty much that's as late as I want to put on a trade so that everyone that's in the group wants to get in, they can partake in that trade. So I'm actually putting a trade on. As we get closer to an earnings date, what happens is the market makers and the market in general just starts to now anticipate the potential for an outsized move. based on the earnings. If the earnings are great, stock could run up. If the earnings are bad, stock could go down pretty harsh. So what they'll do is they'll build in that IV prior to the actual event. So leading up to it, about a week or two ahead, they start to increase the implied volatility. In the last couple of days, it really goes up. Now, yes, you can put a trade on that takes advantage of leading up to the earnings day. They call those calendar trades. Or I'd like to do it on that day. Like I said, I'll put my trade on, and I usually sell premium because, again, they've got elevated implied volatility. So the IV rank has gone up. I'm going to get the most amount of premium right there before earnings comes out. Now, once earnings comes out, there's something called the IV crush, because now that the news is out, whether it was good, bad, or indifferent, now the market makers can kind of breathe easy and know what they're looking at. And so now the IV comes out of all these positions that they just juiced it on. And so right there alone, a lot of times you could be profitable just from the IV crush, even if the stock makes an out of the ordinary type of a move for itself. So yeah, I love setting trading earnings, but it also has to make sense with the setup in the chart. I have to know that supply and demand is support and resistance is going to be looking just right. I have to get enough premium for the trade. So not all earnings trades are great trades. You have to be very selective.
Excellent. I don't want to add any more on that. I think, Uzi, you covered it perfectly. And IV crush is a great way to make additional money. This is a really good way to trade put credit spreads. This is also a very good indicator of when you should jump in on it. So we are naturally a little bullish on the stock that we're entering into, and we at least want it to be neutral or bullish. So we don't want to be picking up these bearish or downward trending stocks. What we can easily do is find an upward trending stock. If you look over at MU or RTX right now, they're both having a nice upward trajectory or a nice upward trend. We're seeing the 200-day moving average go upwards on those. If they ever pull back and say they touch the 50-day or the 20-day moving average, or even the 200-day moving average, that's a fantastic opportunity to quote unquote buy the dip, enter into a put credit spread. You can enter into down here, like this is the entry signal. You might be able to sell this one down here and still get fantastic premium, because as it's coming down like this, it's going to spike. So if you don't know how to pick a stock for a PCS, just look for a nice upward trend, wait for a pullback, pull the trigger, and enter into that put credit spread using the rules that we've already talked about with Delta 25, Delta 35. And I think you'll get a really good bounce on that. All right. So that's a really good way to quote unquote buy the dip and into a put credit spread. Base hits, not home runs. One of the best things about coming into Cashflow University is you get to see different trading styles across our pro traders and also some of our member traders too. So thanks a lot, Uzi, for being with us. And with the put credit spread, you're not going to be going for home runs, where you're going to go for our base hits. This is a really good supplementary trade that you can have alongside maybe some of your more higher conviction stocks that you have, or maybe some of the leaps or aggressive trades that you have. So this definitely should not consume all of your portfolio. You're probably looking at a nice allocation off to the side. I have shared my portfolio with our CFU members where I show the stocks that I'm in, and I use those as collateral to sit against the put credit spreads that I'm entering into. Those put credit spreads are not always against the same stocks. I'll see a trade over on the other side there, like IBKR. I want to jump in on that. Doesn't necessarily mean I have IBKR shares, but I would be able to extract income off of IBKR while I'm holding my bag of like Tesla or Bitcoin and IBIT, which are my more higher conviction trades. I'm just looking for some nice solid income. Give me $100, $200, $500, and just sit on the side there and leverage Bitcoin or Tesla or Nvidia or Palantir off on the side there as my security against those put credit spreads. As you get started with put credit spreads, you'll be able to get some base hits, and don't be expecting home runs with a put credit spread. And again, this is just one system, one way of trading that we have at Cashflow University. If you go in and see some of the other trades, say, for example, with Kyle, he's hitting more of those home runs, so to speak, and he's able to deliver outside excellent returns. Avoid the gamma spike. And this gets back to what we were talking about earlier. When you're down to like a dime or 5 cents left on your position, don't be sitting there waiting for that last little bit of expiry. I always want to enter into a put credit spread with an 80% profit target. Once I hit that profit target, I'm out. I'm not going to wait, because as you get closer and closer, when there's a week left and the price is really out of my target, like the trade's done, like I'm waiting for the last dime. Don't be doing that. Get out of that trade and move that capital over and enter into a new trade, because what you're exposed to there is gamma risk. So gamma risk is the acceleration of delta. So as your delta closes down and gets very close to 0 or 1 or 5, the trade's done, and your gamma is going to start to spike as it gets closer and closer to expiring. And so if by some weird chance a tail risk happens, you're now getting more and more exposed to those outlier events that could really move the stock and expose your trades. If anything happens untoward or against you, it's going to spike. And now you've gone from a profitable trade, and now you're deep in the money because it moves so quickly. This happened to us when we were in EA Sports. We had a call credit spread against EA Sports. And then we were betting that it was going to stay below 165. And then lo and behold, somebody decided to buy EA Sports for $200 and it spiked on us. And we just weren't able to cover that. And we had to take that as a loss, as a losing trade. So don't wait for that last time. Get out while you can and book your profit. Common mistakes. So selling in low IV, and a low IV, like Uzi was saying to us earlier, when you're in low implied volatility, you're not going to be getting a lot of premium. So in a low IV scenario, it's not worth it. Go find something else. So if you're going to come in and do a put credit spread on Johnson & Johnson, what's going to happen is you're going to have to go really tight to the money in order to get enough premium to justify your time in being in this trade. But then you're going to have to buy a long put that's like 10 points out. You're really up tight to the money. You have a lot of spread within your credit spread, and your reward to the risk that you're taking on just isn't attractive enough there. So when that happens, I would just avoid that stock altogether. And I would go to something that's a little more liquid, higher beta, higher implied volatility. You can sit further out of the money. You can tighten up your strikes, get enough premium to justify your time to be in this trade, and you're going to get there. I don't like trading earnings. I know Uzi likes to trade earnings. So if you like to trade earnings, jump in and follow Uzi's trades. If you like to stay out of earnings, then you want to come over and trade with me with weekly income and some of my other systems that I'm running. We try to avoid those and just make sure that you're fully aware of the risk that we're going to take on. But by and large, the system trades that I'm running, we like to avoid earnings. Don't hold through expiration, set that 80% profit target and jump out. And lastly, oversizing positions. If you're new with Cashflow University, start with one contract. I know people come in, they're like, I want to trade 10 contracts. Please don't do that. Just trade one contract. After you've gotten used to our systems and how we operate, and you see, okay, yeah, I'm ready to go up to 2 contracts. I'm ready to go up to 3 contracts. Because what happens is we open up quite a few trades, and then slowly over time, we'll harvest those trades for profit and we'll generate substantial income for you. But what we're relying on is that maybe not every single trade is going to go to profit immediately. Maybe it's going to take a week or two. And so we need that time buffer. We need that exposure over time over different stocks for us to be able to get you a substantial and consistent income system going there. So don't oversize on your first trade that you jump in, because that's going to frustrate the system when we're trying to allocate you across different trades as we go forward. This is a very important part. You want to track every trade that you're entering into. So I don't care if it's an Excel sheet or you download it from your brokerage, but track your trades, record things that happen. Like, did it ever get touched in the money? Did you ever get scared? What did it feel like? Because I think what you'll find over time is some of your worst trades will end up being some of your best trades. And those quick wins, you don't really learn a whole lot from those. You just book the money and move on to the next trade. And those are great. Don't get me wrong. I like those trades too. Those are definitely my favorite too. It's like hitting a 3-pointer. But those trades that you have to grind and get into it and you really do your analysis and how am I going to get out of this? I got into trouble. Those are where you're going to learn your best trading techniques, because now you're going to become more resilient and more skillful when you get into the same situation in the future. Time repeats and you're going to have that same situation again. And so tracking your trades and tracking your exits, having your profits and your targets, those are all real good ways to become a better trader. We journal all of our trades here at CFU. Here, I'll pull up our charting here. So what I'll do is I'll just go over to joincfu.com. This is our website that we have. If you're a member and you're not using this site, please start using it. It's a fantastic website. You go over to member login and it will authenticate you. I'm already pre-authenticated because I'm in here too often. And so it just knows he's back again. So it doesn't even ask me anymore. Well, actually, I do have to authenticate every once in a while, but it's like I got like a 30-day cookie or something like that. But I come in here and this is the options, elite dashboard. If you're a free member or you just started with CFU, you likely don't have a dashboard. It looks like a little more trimmed down, a little more simple. When I come in here, I get my current position. So I can open this up. These are all the current positions that we're tracking as of right now. So we did roll the RTX trade, so we need to update that. It doesn't take us very long. But these are the trades that we're tracking right now. And what I can do is I can go into this one here. This was actually a free trade that we shared with everyone. This IBIT trade where it's cash secured put. I can click on that. And what it's going to do is it's going to bring me down here and it gives me the full details of it. So it tells me the system, it tells me the goal, it tells me when it's going to expire, the premium we captured, how much profit we can have in total, which is obviously going to be $41, and how much capital I'm having to put up in order to secure that. When we do cash secured puts at CFU, we put the total cash amount that you would be required to enter into and secure that trade with. So 31.59 there. But this is where it gets cool. So we have risk decay metrics, which don't really work for cash secured puts here that we have. And then we have the strike that we entered in, and we have the transaction history here. So this is a way that we keep track of all the trades that we're entering into. Now, what we can also do is we can look at our closed positions here. So we closed off NVIDIA covered call, another Palantir covered call, an SPX call credit spread. And so you look at this, took us 5 rolls to complete this trade. This took us 161 days. Now I know what you're saying, like, oh gosh, man, 161 days. But through this process, we were able to generate substantial credit that at the end of the day, we got you out with $290 of profit. This is definitely not our most desirable trade, but it does show the mechanism and method by which we operate. And we're able to show you how we can time and time again get these trades toward profitability. So this is a long duration trade, but we also have some shorter ones like this one here on IBIT that took us 7 days, 4 days, right? So options action is a lot better to show you because these are ones you're going to be able to get right away. So IBKR, SM 8 days, 14 days, 7 days on Google, 98 days on the Qs. So on this one here, this took more time. And so you can see how we were able to generate substantial credit off that there. So this is how you're tracking your trades. You just get a story and a history of how every trade went for you, and you can keep track and see how it goes. Very important. And I believe that is the end of our presentation here today. So hopefully I've answered all your questions that you have for our put credit spread, how to get in, select your strikes, and manage any risks that come along with that. If you're new to Cashflow University, if you haven't signed up, you haven't got in with us, head on over to joincfu.com. We have a introductory kit that gets you into our Discord, gets you our free ebook, it gets you access to our trade scanners. So you can come in and begin trading with us. If you're watching the recording and you have additional questions, drop them in the comment or jump into our Discord. Feel free to ask us inside there and we'll get you going and trading. Thank you for being with us here today. We'll be back next week. Next week, our plan is to go over high yield ETFs. Are they good? Are they bad or indifferent? We'll get into that and share with you our thoughts and analysis on high yield ETFs. Thanks everyone for being here with us, and we'll talk to you next week. Bye-bye.